Hey guys, welcome back to the Bitcoin Fortress podcast, where we build one block at a time and cut through the noise. It's November 9th, 2025. We are at block height 922,897, Moscow time 965. Fees are 1, 1, and 1. So the mempool is quiet here on the weekend. Lots of signal to cover this week. We have markets, miners, lightning, global adoption, two big fiscal and housing proposals that came straight out of Trump's Twitter, actually, his Truth Social account, that have massive implications for Bitcoin. So, with that, let's jump right in. Get started here with markets, flows, and liquidity. First item to go over CoinShares reports 360 million of digital asset outflows, Bitcoin ETFs, about 946 billion. Biggest chunk came early in the week, selling pressure slowed by Friday. ETF redemptions do not automatically push coins out onto the market. The authorized participants that are in the middle of these often neutralize their positions via futures. Historically, persistent outflows don't kill an uptrend. They often mark consolidation before the next leg. So, again, sideways markets train conviction, impatient money exits, long term holders accumulate. First signs of stabilization uh, in ETF flows showed up on Wednesday and Thursday. Net inflows into Bitcoin and Ethereum ETFs. Small inflows matter when liquidity is thin. This shows allocators haven't abandoned Bitcoin, just pulled back exposure during the rate scare that Powell said we might not cut rates in December. Again, institutional positioning often shifts before macro pivots. Kind of makes you wonder how they know, doesn't it? Next item, November 5th tape, 137 million outflows, volumes down 38%. So low volume is outsized price impact from small orders. Whales love low liquidity zones to accumulate without moving markets. And the quiet moments are when supply moves from weak hands to strong hands. So don't be a paper hands. Hold, buy and hold, buy and hold. CME Bitcoin futures showed open interest rising even as the ETFs bleed out. Hedge desks and funds are positioning for volatility expansion. Now, of course, that could mean up or down. Basis trades are widening. Professionals expect bigger moves ahead. So, smart money prepares early. Quiet derivatives growth usually precedes big trend shifts, and don't fall asleep. Bitcoin could move. It will do whatever it wants to do, as I like to say. It could go way up. It could go way down. Um, Stay humble, Stacks ads. Next up, macro and policy. First item here: Genius Act comment window closed on November 4th. Now the rulemaking begins. So the US finally has a real stablecoin framework, disclosures, reserves, custody rules. Institutional risk teams love clarity. They expect now we expect banks to quietly start stablecoin rails in 2026. And of course, stablecoins help onboard billions because, of course, it's pretty easy to flip from a stablecoin to Bitcoin and vice versa. But of course, Bitcoin is the final settlement layer when fiat devalues completely. And of course, it's where you probably want to put your savings instead of in stablecoins that don't pay a yield anymore, which has got to be great for the banks. They must love that. You don't have to pay anything. You don't even have to pay 0.01% anymore. It's fantastic for the banks, not for you. Next item, policy insiders confirm US is no longer following enforcement first crypto strategy. So, staff briefings to Congress say priorities have shifted from punishment to supervision. Global competition from EU and Hong Kong forced US regulators to adapt. And of course, when the uncertainty clears, here comes capital. And capital is good for number go up. Treasury confirms it is retaining seized Bitcoin, not selling it. So historically, seized Bitcoin was auctioned off right away, which was typically pretty bearish for the Bitcoin price, since it added a lot of supply to the market very quickly. But now the government is accumulating Bitcoin. The US government is quietly becoming a long term holder. Now, from the Trump universe, Trump floated a 50-year mortgage in a weekend Truth Social post. The housing affordability crisis has again kind of forced some creative thinking, and now maybe extending the debt horizon another 20 years is the way to go. Of course, there's been a lot of people that have been responding to that saying, wait a minute, you're going to pay $1 million in interest for your $500,000 house. That's crazy. But this supercharges demand without lowering prices and continues to inflate asset values. And of course, even though you're paying interest to the bank, you're paying it with devalued dollars. And so, really, what was it the saying that the your mortgage, your fixed mortgage, is really the asset, and the asset is really a liability in the sense that you have to maintain it. Things break and whatever. So maybe bullish if you're if you're a homeowner. But certainly gets young voters and first-time home buyers who are being targeted with this in the mix. And again, it's all about getting reelected. The fiat system only works if debt stretches into future generations. And boy, do we have a lot of debt. And they're just piling it on. Debt slavery for those that don't know how to manage it. But Bitcoin, of course, requires no refinancing and no counterparty. In a separate but related post, Trump also proposed a $2,000 stimulus checks funded by tariff revenue. I think this caused a little bit of a rally in Bitcoin when that came out today. Um, Tariffs raise prices, but of course, stimulus attempts to offset the pain by putting money back in people's pockets. Of course, this is functionally inflationary. The government increases price levels and then refunds part of it back to you. But again, politically aimed at midterms. And if we look at it from the Bitcoin perspective, the stimulus checks in 2020 and 2021 led to documented spikes in Bitcoin buying. Of course, created a lot more inflation. So you probably ended up paying two or three times in terms of your increased cost of living compared to the dollars that were deposited in your bank account from the Treasury. It's kind of crazy, actually. It's like, no thanks. But people don't care. They want that money. So again, these direct fiat injections kind of give people money that they can use for whatever they want, and a lot of it ended up getting invested in that last go around. So again, these two proposals, 50-year debt and stimulus checks, are certainly handwriting on the wall and evidence that fiat needs constant oxygen and Bitcoin does not. But Bitcoin and other assets, gold, stocks, probably will, if this all comes to pass, benefit from the ensuing inflation that is going to happen. But I guess they want to run the economy hot and get growth at whatever price. Next section, we're going to talk about mining, hash rate, and the AI compute pivot some more. I've been talking about this a lot the last few weeks. First item, hash price hits multi-month lows. Hash rate stays above 1.1 zeta hash per second. So miners are being squeezed by power costs and post-halving revenue. This is when inefficient fleets capitulate and top operators scale. So the difficulty adjustment plus economic Darwinism means the network always survives. Somebody will always pop up if somebody comes offline. And obviously, that's proven out with the continually growing hash rate. Difficulty is projected to adjust down about 3% in the next epoch. Mild relief, but signals miners are shutting off older hardware, or perhaps some are just hanging it up. The protocol self heals, so you don't really need a policy committee to decide whether or not there should be more hash rate or less hash rate. It just does itself, which is great. Moving into some specific miners, Marathon Q3 earnings call leak showed 92% revenue up year over year. AI HPC strategy is front and center. Miners are using their data center footprint to diversify their revenue towards AI. AI demand is real fiat cash flow, and so Bitcoin sort of becomes the bonus asset as opposed to the sole reason why they exist. Miners have really become energy companies with Bitcoin as like a synthetic byproduct. So very interesting. CleanSpark signed a new long-term power contract and is doing some Texas AI expansion. They've locked power at predictable operating costs, and the AI customers pay in dollars. So Bitcoin production adds some asymmetry to their results. Bitcoin mining is becoming a sovereign computing industry. And Riot, with their October update, 437 Bitcoin mined, but the market cares more about its AI roadmap. Wall Street is increasingly valuing megawatts over hash rate. And again, mining's long term security budget is likely going to be supported by AI revenue, which isn't a bad thing. At least I don't think so. Some people might argue otherwise. And finally, Applied Digital secures up to 5 billion from Macquarie. That's a sovereign scale investment. High performance computing and Bitcoin mining share the same resource, cheap energy. Moving along, let's talk about Lightning payments and adoption. So, first up, Square rolls out Lightning to 4 million merchants with zero fees through 2026. No setup friction, instant settlement, and optional conversion to US dollars is being offered in this. The merchant incentive cheaper than Visa or MasterCard. And if you think about it, if even 1% of retail volume shifts, that's billions of dollars moving over to Lightning from Visa and MasterCard. So uh, they don't know it yet, but they could be going out of business someday. Cash App adds Pay Me in Bitcoin plus Lightning Network tipping. So Bitcoin becomes invisible to the user. They just get paid. And this is again what we've been waiting for is when the user experience becomes seamless and you don't even know that you're really using the Bitcoin network. That's how you get mass adoption. UX really is the last barrier, and it kind of makes adoption automatic. So good to see. And finally, two US national retailers are testing Lightning. So again, this is confidential, but credible leaks. We don't know exactly who it is, but if there's one big corporate rollout, that kind of forces competitors to respond. So we'll stay tuned to that and see if anything is really happening there or not. Corporate balance sheets and stable coins. So wouldn't be an episode without seeing what's up with MicroStrategy or strategy. They are preparing a 620 million euro uh, or a $715 million preferred raise, which closes November 13th. Institutional investors are literally funding Bitcoin purchases. And so, again, MicroStrategy has sort of perfected this: borrow cheap, buy scarce. It's funny, I was listening to a podcast the other day of some trader guys, and they're like, yeah, I'm shorting MicroStrategy here. And so be careful, could get your face ripped off. Um, I don't know. I look at the Bitcoin treasuries and I think that the OGs are really MicroStrategy and maybe MetaPlanet. There's several others, but they've kind of got the first move into this thing, so it just seems like they're going to be around. I'm sure that other treasury companies will not be so lucky, but size matters, I guess, in this space. So, but we'll see. And Tether Q3 attestation, 6.8 billion in excess reserves and a $10 billion year-to-date profit. Those are some insane numbers for a company that doesn't have too many employees. Tether is more profitable than most banks, and stablecoins are effectively a shadow banking system, and Bitcoin sits underneath it as base collateral because Tether does buy Bitcoin with their profits and gold too, I think. And of course, they hold everything in theory, hold everything one for one. Uh, every token they issue is backed by a treasury bill. Moving on to legal exchange and enforcement. So again, SEC formally dismisses Binance lawsuit. This came out on November 6th. This is really a massive de-risking for institutions who are worried about exchange contagion. And once the regulatory fear fades, capital and allocations tend to follow. So, very interesting development there. And an update on the FTX estate. They confirmed the next creditor payout. But of course, the payouts are in dollars, not in Bitcoin. So creditors are getting repaid in nominal dollars, but the opportunity cost of the lost Bitcoin is enormous. So don't keep your Bitcoins on an exchange unless you're prepared to lose them, I guess. Cold storage. Sleep well at night. All right, moving on to tech builders and layer two. So, first item in this one is BitLayer upgrades BitVM bridge on mainnet. So, those of you who don't know what BitVM is, it's basically like a smart contract protocol uh, to sort of compete with, Ethereum, Solana, and some of those other things. So there's real usage here. This isn't just a theory. And smart contracts on Bitcoin, without changing the base rules of the base layer of Bitcoin, are really the exciting development because a lot of the original thought was, well, you have to change the protocol level in order to make it do all these other things, and that's what all this layer two development is really focused on, is saying, hey, we can do all these cool things without changing Bitcoin's base layer, which we actually like because it's secure and decentralized. Next up, teams report 1000x challenge cost reductions in BitVM testing. So, if this is true, the Bitcoin can't scale, trust minimized computation narrative. And again, innovation without hard forks is really the way to go, because there's just too many trade-offs with trying to change the base layer. We like it the way it is. At least I do. I won't be voting for any hard forks on my node. Let's just put it that way. And finally, Ordinal's fee pressure returned midweek. So artists and token projects are minting again. Block space, of course, is scarce, and fees do reward the miners and strengthen security. So, the old argument, if you're willing to pay for block space, it's good for the miners, it's good for the network. Of course, people get mad because, well, no, Bitcoin should be financed first, but it kind of is for everybody. And if you find another use for it, as long as you're willing to pay your freight, it's probably not that bad. And of course, right now, fees are very low, as we discussed at the top of the show. Next up, retail positioning and on chain. So, what do we see there? Well, Glassnode has reported that long-term holders continue accumulating. So you've probably heard a lot about the whales selling, but a lot of those whales selling, I think, accumulated their coins relatively recently. The long-term holder supply is near an all-time high. So that means that while some whales are selling into the rally, a lot of others are not. So supply held by hands that don't sell is just rocket fuel. And for most of us here, we're going to be long-term holders too. We're just happily accumulating here in the $100,000 range. Uh, and really, if you do what Sailor does, which is buy at any price, you kind of can't go wrong. Dollar cost average. Funding rates are slightly negative across major exchanges. That means traders are paying to short. So if you have crowded shorts and low volatility, that often precedes violent upside. So, of course, we like to see that. I am getting used to the volatility, although it's hard sometimes, when your portfolio takes a 20% dump, to remain calm. Um, But I wrote about it, and it'll be upcoming in the next few weeks on the Bitcoin Fortress podcast. So check that out. How to stay calm with the volatility and how to, you know, the boring sideways chop. How do you stay calm and not want to do something? Because you really don't have to do anything except just be patient and hold. Touch grass, go outside, take a walk, read a book, do something else. Hang out with your family, go to the range, practice. There's lots of other things you can do besides obsessing over Bitcoin fiat price. And finally, in retail positioning and on chain, realized volatility is at 6-month lows. So, again, historically precedes explosive moves, and those could be to the up or to the down. So, Bitcoin rarely stays quiet for long. So, I guess enjoy it. Next up, let's take a look at international adoption. Nigeria premium widens as capital controls tighten. So again, people turn to Bitcoin when banks block transfers. And as we've seen, Bitcoin demand tends to grow fastest where fiat fails. And we see this all over the world. People get Bitcoin, and they also want stable coins because they want something to transact in because they can't get a bank account, and they also don't want to have a fiat currency that is hyperinflating in their financial portfolio. But people who have dealt with hyperinflation or really bad currencies get Bitcoin first, and people in the Western countries that have the privilege of enjoying a fiat currency that is not hyperinflating just don't get it until they have to. Argentina, another country, hits a new record in Lightning merchant volume. Inflation, of course, is destroying the peso as much as they try to prop it up. It's kind of been, I guess it was been a little bit better recently, but now it's kind of not better. And so Lightning is becoming a daily payments rail for people. And again, we see real world usage under economic stress. So Bitcoin serves many purposes throughout the world, depending on your situation. And it is good money. And finally, we'll take a look at finance and growth. So, first up, there is a report out that US regional banks are testing Bitcoin collateralized loans. So, Bitcoin is used like high grade collateral with transparent reserves. And really, if you think about it, if a bank loans you money, fiat, and then they're holding your Bitcoin in collateral, and they can sell it at any time, and it's highly liquid market, why wouldn't you want that? Why wouldn't you want to make money doing that? So I'm expecting once banks get in the game, hopefully the cost of borrowing against your Bitcoin is gonna drop significantly from the rates that they're currently offering a lot of these Bitcoin lenders. Um, but again, Bitcoin as super collateral is kind of becoming a real thing. And finally, Strike is expanding its US rollout plus Plaid integration. So they're trying to get to seamless bank and Lightning onboarding and trying to make the on ramps frictionless. Strike really has an interesting. I don't think they're in California, but they do offer Bitcoin lending throughout the U.S. and most states, I think, except for the ones that are really strict. And then, of course, they have bill pay and all this other stuff. You can buy Bitcoin, and you can actually get paid in Bitcoin. So they're doing a lot of interesting stuff for sure. Did want to mention this week's featured Substack post, the Bitcoin Lifestyle episode 4. This is a video, kind of short video series I put together based on my recent book, The Bitcoin Lifestyle. And it's really a deeper look at the spiritual and philosophical side of low time preference. Bitcoin doesn't just change how you invest, it changes how you live. Also, want to mention the Bitcoin Fortress book series, and I'll put links in the show notes to the featured Bitcoin Substack post as well as the books. We've got Bitcoin Fortress, a simple guide for beginners, nice orange pilling type beginner's book. A heavier book, Bitcoin Retirement and Estate Planning, that kind of goes into great detail on how you can do all that. Tried to keep it as simple as possible. And finally, like I mentioned, the Bitcoin Lifestyle, more of a less technical book and more about maybe philosophical and spiritual. Took a look at the weekly podcast universe for Bitcoin podcasts, and here are some themes that popped up. Miners are becoming energy plus AI companies, which of course we've talked about here. Lightning UX finally invisible, also discussed this week here. U.S. regulatory hostility flipping, sideways markets build conviction, not fear, and Bitcoin as super collateral. So we're seeing a lot of the same themes out in the podcast universe. And that about wraps it up here for Bitcoin Fortress episode 189. If you found value in the show, share it, rate it, or send it to someone who needs clarity. And remember, stay humble, stack sats, and we'll see you next week. Bye bye.